All right, so once we've discussed tax household, we're going to go ahead and talk about income. And income, of course, is a very important section because it's what's going to determine the financial assistance the consumer is eligible for. So on this screen, you can see how it looks on the tracking sheet, and we've listed out for you guys the types of things that count as what's called MAGI, modified adjusted gross income. MAGI is not a term a lot of consumers are familiar with, and you do not ever have to use it again. But what's important here is going to be getting a total estimate for 2018. And you can see there at the bottom as well that we're going to want the number of people in the tax household. On the bottom right-hand corner, you can see how things look on the resource page. There are certain keys that will be very useful, like the 2018 federal poverty level chart. And we also have things listed out like the repayment caps, estimating MAGI, and how to figure out certain immigrant statuses who may be eligible below 100%. So why do we look at income? So the reason, of course, is again connected to the fact that the ACA is from the tax code. The Marketplace Financial Assistance is based on an annual estimate of the income of the total tax household. So that's why we need to look at it, is that it determines how much assistance the consumer will get. So looking ahead, when you're entering income on the application, we recommend using yearly or monthly. You're going to spend time cooking together an estimate with the consumer, and if you use a different category like weekly, every 2 weeks, hourly, twice a month, the application will come up with that estimate for you, and we don't want that. So the best idea is to talk to the consumer, come up with an estimate, and then enter that using the categories of yearly or monthly so that you're in control of that estimate as opposed to the application. Okay, so a couple of questions. It can be very challenging to talk about income with someone you've only just met. A good way to start might be to ask how they earn their income, what the sources of their income are, and whether they expect 2018 to be similar to 2017. This can be a useful question, but it's very important to be aware that if 2018 will be nothing like 2017, that is okay. The past does not at all have to determine our future when it comes to this application. So you will see clients who are going to diverge completely from what they earned last year, and that is just fine. The application accommodates that. So this is the FPL chart. You can see, well, it's not the easiest thing in the world to read. It takes a little getting used to. But if you look at the far left-hand column that has a number, that is the total number of people in the tax household. And then you read it from left to right. So if I'm a household of one, to be at 100% of the federal poverty level, I would need to earn a $12,060 income for 2018. And that's when I'll start being eligible for subsidies, usually at 100% of the federal poverty level, if I'm a citizen or long-term resident or have humanitarian status. Now, as a single household, so moving all the way from that 100% column to the 400% column, I will stop being eligible for subsidies at 400% of the federal poverty level, which is 48,240. So of course you need to accommodate what size household the consumer is to figure out their eligibility, but essentially you're reading from left to right. There are different colored brackets as well, which will determine how much of a cost-sharing reduction the consumer is eligible for. So they're going to be eligible for that 94% cost sharing if they're between 100 and 150% of the federal poverty level. If they're from 151 to 200%, they'll be eligible for that 87 cost-sharing reduction. And if they're above 201 to 250, they'll be eligible for a 73% cost-sharing reduction. Right now, those are very meaningless terms, so don't worry about those, but just know that that's the way to identify what the consumer is going to be eligible for in terms of cost sharing. Okay, so we have two subsidies a consumer is available to receive on the marketplace. The first is what's called a premium tax credit. We abbreviate that PTC, which is going to reduce the monthly premium cost for the household. So basically, if the consumer is between 100 to 400% of the federal poverty level, is not eligible for other minimum value coverage such as Medicaid, free Medicare Part A, or adequate and affordable employer coverage, which we've talked about, they can purchase any level of insurance, bronze, silver, gold, or platinum, not catastrophic, that's the one exception, and reduce their monthly premium based on how much of a premium tax credit they're eligible for. So that first subsidy reduces the cost of the actual insurance. The second subsidy is called the cost sharing reductions, and this is going to reduce the actual costs of care. So it reduces what's called the out-of-pocket max, deductible, and the copays. A consumer would be eligible for this if they're between 100 to 250% of the federal poverty level. So those were those three brackets I was indicating, between 100 and 250%. And there are three separate categories within there. They must purchase a silver plan, but if they do, again, those reductions will apply to them. So this demonstrates the impact of a cost-sharing reduction, and it's a little bit of a confusing screen, but basically plans have what's called an actuary value. And what that means is, on average, they're going to cover a certain percentage of a consumer's costs, and the insurance company will cover a certain percentage of a consumer's cost. So a platinum plan, for example, will usually cover about 90% of a consumer's cost. A gold plan will cover about 80%, and a standard silver plan without any cost-sharing reductions will cover 70%. So what you can see on the screen is that when consumers qualify for cost-sharing reductions, they're going to accrue a higher actuary value than more expensive plans. For example, the very, very top block shows a consumer eligible for cost-sharing between 100 to 150%. They get that 94% actuary value, which is better than a platinum. So they would have to pick the cheaper option. The platinum, of course, is more expensive, but if they do, they would receive more in terms of value. Likewise, if they were between 151 to 200% of the federal poverty level and picked a silver plan, they would get a plan with an 87% actuary value. So you can see that's very close to the value of a platinum plan and higher than the value of a gold plan. So again, you opt to pick a silver plan, and you actually would see more value in that than you would in a gold plan. So you pay less per month, but you have more value because of that income. And then finally, if someone's between 201 to 250% of the federal poverty level, they'll get a little bump. It's not huge. A standard silver plan, of course, only is at 70% actuary value, but that cost sharing reduction is going to bump you up just a bit, 73%. Now, in and of itself, percentage-wise, that's not very much, but that can mean thousands of dollars in terms of a deductible and out-of-pocket max. Now that's all very meaningless, I think, without an example, so I'm going to provide you with one. These are based on 2017 numbers because when I put this together, the 2018 plans were not available. But just to give you a sense of how this works. So this is our consumer, Mary, who's 35 years old, resides in Travis County, does not use tobacco. She's single, no children, so household of one, and she works part-time at Austin Community College. She's estimating her 2018 income at $15,000. So based on that, Mary will be eligible for a premium tax credit. And that's the the middle value you're looking at on the screen. So that $268 per month. And that Mary takes that amount and can apply it to any bronze, silver, or gold or platinum plan. And then she's responsible for whatever remains. So we're going to pretend that Mary is selecting a plan that costs $283 each month. On her behalf, that $268 is going to be paid by the Treasury each month to whatever health insurance company she selects. And then she is responsible for paying the remaining $15. So that's how the premium tax credit works. Now, the second subsidy, the cost sharing, is going to be a little more complicated. So because we talked about Mary being at an income of $15,000, her cost sharing is going to put her in that top category. She's going to get that 94% cost sharing. So a lot of value there. So if you look at the far right column labeled without, the deductible on that plan, usually without any cost sharing, when it's at that 70% actuary value, would be $6,100. The out-of-pocket max, which is when her costs basically stop and the insurance company must cover everything, would be at $65. So those numbers, as surprising as it may be, can actually protect a person financially. If Mary had an emergency surgery, the cost of that could be thousands and thousands and hundreds of thousands of dollars, depending. So that $6,500, as crazy it may seem, actually protects her by limiting what she is liable for. Once her costs have met that amount, that's her sort of worst case scenario, the out-of-pocket max, and then the insurance company must cover those costs. So she could, in theory, be financially protected with that plan. However, The cost-sharing subsidies are going to actually reduce those relatively high numbers and make them even more manageable and commensurate with her income. So she'll go from having a deductible of $6,100 to a deductible of zero with this plan. And she'll go from having an out-of-pocket max of $6,500 to $850. So that becomes her new worst-case scenario. So most Americans, unfortunately, have enough experience with healthcare costs in this country to not say this, but we do sometimes hear consumers say, I don't need health insurance, I'm not sick. And of course, the response to that is that you really can't plan for an accident or a medical emergency. And this is an x-ray of a consumer who broke their leg and had to have a couple of different pins put in it. And this here is an emergency room bill. Now, my understanding of this bill is that it does not include the subsequent surgeries. It does not include physical therapy. This is just a straight emergency room bill for a mere $53,000. It's so nice how they ask that. Please pay this amount, $53,000. So for this consumer, her out-of-pocket max, of course, was $850. So though she has this enormous hospital bill of $53,000, she should only be responsible for that $850. Again, assuming she was in network and was availing herself of covered plans. Emergency surgery, of course, is one of those covered, required by law, covered services. So she would wind up paying $850 for all these needs, and she would have to keep paying her premiums. But you can see that would be substantially preferable to paying $6,500, but even more substantially preferable to paying the $53,000. Okay, so that's how cost sharing and the premium tax credits work. So a couple of things to keep in mind as you assist consumers with estimating income is that they're accustomed to looking at their income a certain of ways. So first and foremost, if they've done applications for their children for Medicaid or for CHIP, which they would do through Health and Human Services of Texas, they are accustomed to looking at the past income. They're not accustomed to predicting their entire income for the upcoming year. So that may be a daunting task. Consumers know the amount they take home, not the gross earnings. And with W-2 earners, we need to know the gross amount. So they may tell you an amount that reflects their post-taxes amount. And unfortunately, that's not the amount we need. So we can help them with that, though. Consumers are also sometimes unsure of whether they're receiving Social Security disability income, or supplemental security income. The problem is that all of those things sound pretty much exactly the same with all the S's and the I's. But I think the easiest route or the easiest mnemonic device here is that only one doesn't count. Even though most Social Security or a lot of Social Security income is not taxable, it still counts for magi purposes with one exception. And that exception is supplemental security income. The only people receiving supplemental security income will have Medicaid. So if you're trying to, firstly, I would say assume it counts unless the person receiving it has Medicaid. That's usually the easiest way to go. And again, we are available to assist with this if this happens. But usually it'll count. It's just going to be that one category, supplemental security income. And if the consumer has that, they also have Medicaid. And the question would be, of course, are they applying? Because if they have Medicaid, they're not eligible. But there might also be someone in the household who's not applying, but you're trying to figure out if their income counts. And again, if they are receiving supplemental security income and have Medicaid, that income doesn't count. So always I would advise that if there are curveballs or confusions, just stop and ask. You are not expected to be an expert on every single income that exists in the world. Just ask one of our tax experts. And again, my shorthand is always, is it taxable? If a consumer mentions a very confusing, strange income I've never heard of, do you pay taxes on that is what I follow up with. But if you're not able to get a good answer there, always grab one of our tax experts. They'll help. Always a good idea to remind consumers that cash income is taxable. That doesn't mean that you're responsible for figuring out what their tax income is, but if they have questions or mention stuff about under the table or there's any sort of weirdness there, you can just remind them politely that cash income is taxable. This is an actual curveball a musician threw at us at one point. What if my album goes platinum? Kind of unreasonably. And then we will get the much more reasonable question about someone who's currently job hunting. They're unemployed. And how are they going to predict 2018 if they're not working currently? So what we recommend for those scenarios, this sort of